Hi, Mark McKenzie from Wardle Partners Accountants in Caloundra. Just wanted to give you an example of some of the tax planning we've been doing and just highlight the importance of it because with the 30th of June fast approaching, once we get on the other side, it's too late for this financial year. So this is a really simple example and it involves superannuation contributions and so this is an example if we just work through it. So say for example we've got someone earning $50,000 a year and they've sold their investment property during this financial year. So now they've got a big capital gain and we've worked out the capital gain and it's $100,000. So that gets put on top of their normal salary income. So that'd take it from $50,000 up to $150,000 of taxable income this year. Now at $150,000, that's in the 37% tax bracket plus Medicare takes it to 39%. So one of the options available for this person in this scenario would be to use some of the sale proceeds and top up their superannuation with a concessional contribution. And this year, the maximum that everyone is entitled to claim is $25,000. So from all sources, any amount going into super, no more than $25,000 to be claimed as a tax deduction. So in this example, the person had a $50,000 salary. So with their super guarantee their employer is paying, it's almost $5,000 they will have already received from that in the year. So they're allowed 25 in the year. That leaves them about 20 grand that they could put into super if they so wished. So if they did put 20,000 in and claim it as a tax deduction in their personal tax return, that would bring their income from $150,000 down to $130,000. But what does that look like in the grand scheme of things and how much tax they've paid? It's quite simple really. I mentioned earlier, they're paying 39% tax in that bracket, 37 plus the 2% Medicare levy. And when the contribution goes into the super fund, it has to pay a 15% contribution tax. So the difference between those two rates is the overall saving. They'll save 39% personally, but when it hits the super fund, they pay 15. So overall, a 24% tax saving. And on, say, for example, a $20,000 contribution, that would work out at $4,800 in tax save, the net tax benefit. And of course, the money goes into your superannuation fund, top that up. So before any sort of decisions like this are made, we fully recommend that you speak to a financial advisor, and we could refer you to the great team of Compass Financial Solutions that partner with us and work here at our premises, and we've been associated with them for many years, just to go through your circumstances and make sure that that type of strategy is right for you. But what I've done today is explain the taxation implications and the benefits of that, and that's that type of scenario. The key benefit of putting money into superannuation, the tax benefit of it, applies to all scenarios, and it'll just come down to whatever tax bracket you're on. The higher the tax bracket, the more net benefit there is when you make those concessional contributions. So 25,000 is the maximum for everyone this year, and obviously it certainly does pay to plan that. Come and get a proper advice about it and before you go doing things like that. But on behalf of all the team here at Wardle Partners in Caloundra, we're in the middle of tax planning season, and I hope this tip's been of use to you. Thank you.